Hello, everyone, and thank you for joining us today on the Dairy Signal. We are going to be diving into the world of agriculture markets, but before we do so, we have to start out with a thank you to our sponsor for the Dairy Signal in the month of April, and that is DLF. And they are committed to supporting dairy producers and dealers with genetics and varieties that they have come to know through Dairyland and Pioneer suppliers.
We'll kind of start like we always do at the very highest level, and that is, we are at war again. The last 30 days have been incredibly chaotic. Fuel prices are up. Crude oil can move. We've seen by $18 per barrel in a given day. A lot of anxiety, in the ag space, rural America, the financial markets, et cetera. But I think when we think about future risk management, milk producing margins, et cetera, something at Ag Resources, we want to stay cool, calm, collected, focused on the forest, not the trees. And what we have come up with after lots of work is I think we're going to look at this through the lens of kind of ignoring geopolitical chaos. What we're going to be focused on, and I think price discovery ultimately hinges upon this, is physical supply and demand. And I don't think that's going to be any different in 2026. And so, with that said, again, having spent a lot of time on the nuances of markets, we're kind of left where we were 2 weeks ago, 4 weeks ago, and 6 weeks ago. The milk market still very clearly balanced. You have very intense rallies on certain weeks, very intense breaks like this week on other weeks. And that's because I think either side has a case to make. And given, alternating weeks, the bulls and the bears are going to win their case. So you look at demand for dairy products and milk in the US, it's incredibly large, something we've never seen before. Then you look at kind of the lack of urgency in rallying these prices is because we're still producing an incredible amount of stuff. Even high protein whey concentrate production is adequate to meet demand, which is very good. Milk production growth on track, European milk production growth, New Zealand milk production growth, all those things still linger in the background. And I guess to some extent, we are kind of thinking about the fragility of global economies given high energy costs. Is that this summer going to, on the margin, reduce spending on food consumption? We're unsure. Now, it's going to be very touch and go, but just wanted to communicate, the stage has been set still. The range we have seen, volatile, wide ranges in class three, probably are the ranges that we're going to see for the next 6 months. So again, something that we've highlighted is that makes, despite the headline risk, the daily changes in prices, makes the outlook kind of uncomplicated. You know what to do when we're close to $19 summer autumn contracts. If you're an end user or a buyer of dairy products, you know what to do when we're at $17 in the spot class three market. So you're buying and you're selling within that range. We also think that ultimately feed markets are going to dislodge from crude. And I know that's kind of counterintuitive to what a lot of people have, talked about and written about since war in Iran started. But we have seen that many, many times. We do not think that crude oil at or above $100 a barrel by itself is a meaningful variable for the price of corn or protein meal. There have been times when crude oil has been at $80, $90 per barrel, and cash corn has been at or below $3 per bushel. So it just happens to be that oftentimes crude oil supply and demand is the same as corn supply and demand. And that's why you get those correlations, why they move together. This year, we think that the two markets' balance sheets are very different. Depending on how the Strait of Hormuz evolves, the crude oil market, distillate market could be very tight. The corn market to us is not tight, and we think gets looser in the next 6, maybe 9 or 12 months. So again, if you recall 2 weeks ago, this outline has been completely untouched. It is exactly the same. And so those are the kind of market scenarios we want to think about. I think that income over feed costs are going to stay elevated, maybe get a little wider between now and the end of summer. I think milk, pretty neutral trend. You can't break it because we are consuming an incredible amount of dairy products in the US and globally. But you can't really find the ammunition to get, even forward contracts of class three above $19 a hundredweight because we just have lots of milk, producing lots of dairy products while we're using it. So again, just kind of perfectly balanced. And I think one of the issues that we'll kind of highlight here is as we're getting into a new growing season, the simplest way to think about the feed markets, especially, is there's a lot of stuff on planet Earth today. The Southern Hemisphere growing season, South America, not quite over with, but we have checked off a lot of boxes when it comes to risk, given it's April 9th or 10th. There's not a lot of risk to those production levels at this point. So those are kind of locked in. So we're kind of moving to new crop weather. There are going to be perceived threats, of course, and this is very crystal ballish. I don't know how the summer evolves in the Midwest or the Black Sea or Europe, but so far, so good. Even the climate signals that we're getting, it looks like risks of long-term issues is being diminished. It's not expanding. So I think there's just going to be a lot of physical feed supplies available, and that's why I think corn has dislodged from crude oil, as soybean meal as well. I mean, that dislodging probably stays in place. So again, like we highlighted 2 weeks ago, it's been a pretty chaotic class three market, but you can kind of see the stage is set, and it is still set. And so we did test $18.50 in the nearby market, but also failed at that level, which makes a lot of sense. So you can't really afford, and I think the theme is you can't really afford to lose a pound of dairy demand. While it is very, very large, given we've got this large stockpile of raw milk, dairy products globally, we're still producing a lot, cow numbers, beef revenue, et cetera. If the market does find a price that does start to kind of ration or curtail forward consumption, it can't do that. So I think that more or less explains the break this week. Given also we had a bi-weekly global dairy auction, and those results were negative. Markets globally and the cash market have corrected kind of across the board. So the U.S. has got to keep its share of world trade, which is high, but there's going to be more competition. That's why I think we've got this ongoing, chaotic, wide-ranging, but ultimately neutral class three market. I do think, though, a silver lining, and we have heard from clients, and this makes fundamental sense given the market that we saw, from December to, the end of January. Cash milk checks, not very attractive. We do think that changes. And I think of course, we can see what class three has done. But I also think when you get into the kind of the ancillary markets, whether it's non-fat dry, cash whey prices, relative performance in the fat market as well, there's going to remain this $2 or $3 hundredweight premium when we look at these price models with just comparing class three to physical statewide or national average all milk prices. So it's fairly easy to back into what we're going to see for the month of March, for the month of April, May, June, and July as well. So we are probably going to add 50, 80 cents, maybe $1 to cash milk checks, I think, over the next 100 days. Our price models, given, again, relative strength and fat, performance, whey, non-fat dry, et cetera, probably $18, $80, or $19 national average cash milk in March, $20 in April, maybe upside to $20.50 or $21 at some point between now and September or October. So I think cash milk does improve income over feed cost. On the margin, will be getting better, not worse. And that's what we're left with. And I don't think that it's going to be easy to change these relatively wide ratios. I mean, on one hand, the only way to capture this is to lock it in. And we'll say it, for the, sixth or seventh consecutive dairy signal, $19 class three milk is a sell to us, unless something pretty dramatic changes with respect to production levels. And we don't see that coming. The only way to lock in, what seemingly are pretty profitable levels compared to protein meal, above average levels when we compare milk to corn, it is to kind of lock in feed, hedge forward milk production. But also, again, I don't think that these are going to change very much in the next 100, 120 days specifically. Seasonal trends are what they are for, a reason. I think ultimately all of this, despite all the chaos, the various analyst fights, this is all rooted in physical supply and demand. The dairy markets are weak in winter because we tend to build stocks. We don't consume a lot of dairy. That market's pretty myopic. It's got too much of it on January 15th and the market breaks. Milk markets rally thereafter because we start to use more of it and things balance themselves out. Well, the same thing is true in something like protein meal or especially corn. We are soon to, if we get into the growing season and we don't identify threats to places like the U.S. Midwest, Ukraine, Western Europe, the perception of the market is that we're going to have the most supply available, come technically, September 15th, something like that. So the markets are going to break, and that happens kind of year in, year out, unless there's pretty dire weather. And I think that holds again. And we'll kind of identify or get into the details of seasonal trends in a bit. But anyway, that was a long-winded way of saying I suspect these ratios at best stay where they are now, if not widen over the next 3 or 4 months. And just kind of real quick, without getting into too many of the details with dairy supply and demand, because it looks very, very similar to the way it's looked for the last 2 or 3 months. We're record amounts of stuff. We're making record amounts of stuff disappear. And this is largely a function of exports. The US markets, today at least, are still very competitive. So I think we're going to see exports of cheese, even non-fat dry, butter, stay at pretty historically large levels. But we can now, with the data we've got, back into actually how much we are using compared to stocks, and demand 8% better than last year when we look at American cheese as a whole. So up about 46 million pounds, from 27 million pounds from last year. Stocks only 785 million pounds. And so you can see that this demand, exports, is challenging or eliminating the chance of building inventories. I don't think that the cheese market has to ration supplies, but I think we can say for the next 3 months, we're not really going to be adequately building reserve stocks. So the market's kind of on the cusp where you got to keep production levels high. Milk production needs to be very good. We can't lose demand, but I don't think we're going to lose it for the next quarter. So there's not a whole lot of American cheese in the United States compared to history today. And that explains why we have seen $19 class 3 in the forward market. Butter is even better. And I think what's different this year than last year or the year before that is, and something that we've highlighted, is net butter exports. Those are now adding something like 15, 25 million pounds per month to demand. That is the opposite of last year when we were adding via trade 5 to 8 million pounds to supply. So there's been this 20, 30 million pound swing. In any case, we used 203 million pounds of butter in the month of February, a record up 20% from the previous year. And you can see here, like cheese, that has eliminated the chance of building stocks to or above year-ago levels. Really, the last 5 years, we're kind of the lowest level since 2019 in butter inventories as of the month of February. Down 50 million pounds, 17% from last year. So again, there's not a lot of urgency here. We don't need to ration butter, but we're not going to have an incredible amount of butter come October, November, December. So I wanted to plant the seed that, again, thinking about the context, the dairy market's fairly myopic, short-sighted, focused on supply and demand today or this week. The market's going to be, I think, pretty tight, barring kind of economic calamities come holiday baking season. So I think we are comfortable having end users get covered through the rest of the year at these prices. National wholesale price, about $1.70 per pound. We think that has pretty good value. I don't know if we're going to see $3 per pound butter come up August, September like we have in the past, but I can certainly see $2.25, $2.30. Class 4 adding some premium. Cash milk doing better than it has the last 90 days. And so the butter supply and demand balance sheet is not loose. It is relatively tight compared to history. I think to the point where we've only got something like 32 days, 34 days maybe of consumption on hand in cold storage. So again, it's not direly tight, but again, it's not abundantly loose either. We've got about a month on hand, and I think that probably stays the case for the rest of the calendar year. Just right on time butter supplies. And here's what we see in terms of export demand. So it's only getting stronger, especially in the case of cheese. Cheese exports February officially, all varieties, an all-time record 58,000 tons or 128 million pounds, 30% from last year. And like we have highlighted here before, it's very easy to see why this is happening, why it's been happening, and that it will continue at least for the next quarter. U.S. cheddar is cheap. We'll kind of talk about in a little bit that discount is narrowing pretty quickly, but at least for the remainder of spring, if you're an importer and you want to save money, you're buying cheese from the United States. So I think we're going to see 55, 60,000 ton export when it becomes official for the next 3 months. Net butter trade, very quick shift from being a net importer to a net exporter. The butter market is still about 30 or 50 cents per pound below comparable markets in New Zealand and Europe. So net exports probably continue as well. Going to be challenging inventory building. I also wanted to very quickly, something that we don't often talk about is just kind of isolating what we think is the best proxy for this newfound world interest in consuming protein. Identifying the highest protein whey concentrate market, and it is not loose at all. So we've got record demand, about 31 million pounds in the month of February. It was 32 million in January. And you can see the stocks contraction that happened very quickly about summer of 2025. And even in February, we consumed about 1 million pounds more than we produced. And so while the market is beginning to encourage, high protein concentrate, whey protein concentrate production growth, it's not enough today. And so I think the high protein whey market is going to stay very, very tight. And that gives us cash whey prices performing seasonally, but also about 15 cents per pound above where we were a year ago in early spring. So again, I think that this is all positive, again, to cash milk price determination, but also I think serves as a proxy for showing us just this newfound demand globally for protein. It's very, very much in vogue. That works to the benefit of the U.S. dairy farmer. But again, why there's no market urgency here is because one week we are focused solely on look at how much cheese we have exported and will continue to export. Are we going to be okay? The high protein whey market, et cetera. But then alternating weeks, we get production data and it's showing us that producers globally are doing very well and continue to respond to pretty decent margins. Only until the last 45 days or so, cash milk in New Zealand was 20 cents per pound, an all-time record by a pretty wide margin. So there's incentive to produce in New Zealand. Still an incentive to produce in Europe. New Zealand production as of February up 6% from last year. Now 15 of the last 16 months we have seen production growth in New Zealand. The last 3 months production growth in Oceania as a whole. And Europe pretty similar, just pretty incredible numbers. The United Kingdom, in fact, probably has seen the biggest recovery from last year to this year in terms of milk production. So everyone can see, what until fall of 2025 are pretty elevated milk prices, cash and futures, and also this demand for protein. This is no secret to people in New Zealand or in Western Europe or Australia or Argentina. So is this evolving to the point where maybe starting second half of 2026, our share of trade may be challenged? It's not happening yet, but I wanted to show this just to kind of explain why you do see breaks in class 3 that are pretty considerable, like this week. And this is, I think, the one thing that we do want to be cognizant of in the context of our recommendation to sell, even at this point, 50, 75-cent recoveries. Have an eye on hedging Q1 2027, because again, to change the structure of the market, to see a price range outside of the range we've seen for the last several weeks, something different has to happen. Balance sheets need to be different than the way they're presented today. We've got to see, I think, production contraction in some major exporting country, and we don't see that coming, at least in the next quarter. The European cheddar market seems to be coming for the U.S. market for the first time in about 13 months. So now that the U.S. cheddar market discount is down to about 12 cents per pound. It was 60 cents per pound last summer, autumn, and throughout much of winter, but it's evolving pretty quickly, and it does look different. Part of this is relative currency weakness, but it does seem that given the European Union and United Kingdom have been producing more milk now for the last 9 months, the cheddar market's getting looser. They probably start to go after world market share second half of this year. So this just shows you that it's not all one-sided. Think about upside potential in class 3. It is capped by, I think, wherever the European cheddar market is. So that is about 18.5 to 19 cents per pound basis class 3 future summer and autumn. We're also going to have to contend, like we always do, with just sort of peak northern hemisphere milk supplies. And this is not insightful. We have seen this for the last 8 months, really, but the cow herd. And again, probably because of beef prices and beef cross revenue, record 9.62 million head. Now, we've grown the cow herd by quite a bit, especially along the spine, large beef producing states, Texas, Kansas, even growth in New Mexico, Arizona. I think that's kind of a function of the beef market, but this provides this base from which to continue to grow milk production. And I know this is a different market. The last couple of years we have dealt with, the arrival of bird flu, fixing bird flu, beef cross, beef revenue, et cetera. But generally speaking, if we look at the last 2 decades, cow herds do tend to expand nationally during spring and into early summer. So I only mention that to say that we're probably stuck with something like 9.6 million head into maybe Q4 of this year. So if you did come up with, per cow output growth like we have seen for the last year, 0.5%, 1.5%, you're left with just a very, very large U.S. milk production. So that I think explains the other side of this. Demand, very, very good. Levels we haven't seen before, but there's still this absence of urgency in the market when we think about price because we're going to be fine. We're going to produce our way through this. And I think the data is showing us that that probably is going to be the case in 2026. So now we move on to feed, and something that's jumped out to us the last couple of trading sessions is one, volatility. This is all very chaotic. Following headlines has been the job of most people every 30 minutes. But when we think about what's happened since February 28th or the following Monday when it was confirmed that the U.S. is now involved in Iran, and so that is starred on the May corn futures price chart on the left. And you can see that technically today we are a couple of cents below that price. And so I think that one shows us that the market's kind of gotten exhausted by what's happening geopolitically. Also, there's just more than enough corn today in the US. There's going to be a lot of corn in South America. US weather, I don't know. The growing season hasn't even started. But again, climate signals are such that odds are favoring something like normalcy this summer and autumn. But what you do see on the right is what has changed since war is the sort of speculative or the behavior of the speculative community. So funds have bought a net 350,000 contracts of corn since the middle part of winter. And so we put these two together, and now I guess kind of back into something like 60,000 contracts are today underwater. They're losing money. So something that we're concerned about when we think about, I guess ignoring supply and demand, weather patterns, just the flow of money is, does this position get unwound if the Strait of Hormuz does allow something like semi-normal vessel traffic, if there is resolution between Iran and the United States and Israel, war outright ends. Does this position kind of go away completely? That's at least 30 or 50 cents of downside risk in the corn market. And it's not just corn. This would look the same whether you're looking at soybean oil, soybean meal, soybeans, or Chicago wheat. So the unwind. And also thinking about some of the smartest opinions that we trust, just thinking about crude oil not going to $150 per barrel. It's interesting, at least. It seems like governments have been able to at least react to the point where we'll release reserve stocks, we'll produce more, we'll do more solar, wind, renewables. Maybe it doesn't care. Geopolitical conflicts don't carry the same weight in energy markets that they did 10, 20 years ago. So anyway, I think the message here is that the end of war in Iran leans bearish, and even a persisting war maybe not be as bullish as it has been the last 2 weeks when we think about feed markets. Again, I think we're just kind of divorcing ourselves from the crude oil market and geopolitics. And this is why. So in the last 2 months, in the last 6 weeks specifically, since conflict in Iran started, we think very, very hard about how do we change supply and demand. Today, forecasts for next year in the United States, in all exporting countries, and there's really been nothing that we've been able to change. The USDA's WASDE released about an hour ago kind of agree with this. All they've done this month is raise U.S. wheat stocks 7 million bushels because we're importing more. No other changes to stocks have been made. And so you think about like the details. Well, I guess if energy prices are elevated and we're concerned about the flow of crude oil, distillate products, et cetera, maybe the U.S. will be this dominant exporter of ethanol to markets that don't currently produce their own ethanol. But even then, it's hard to change that number because we get data every week. Nothing's really suggesting that the USDA is wrong. And we've got capacity restraints. I don't know if it's 2 or 3 years from permitting to production when we think about ethanol plant construction, but we can probably only use maximum 5.7 billion bushels of corn annually given current ethanol production capacity, which is a pretty hard number released by EIA every year. And so I don't think we can really go above that in terms of domestic corn use this year or next year. So the corn balance sheet is unchanged. And that's why I think, again, knowing we've got a lot of stuff today, South American weather looked pretty good. Can't physically change balance sheets. That's why corn's divorced itself from the energy markets. And to that end, I think this is the snapshot of the physical corn market today. Is March 1st U.S. corn stocks were 9.02 billion bushels, the largest ever. It does imply we're using a lot of corn, but also you extrapolate the next quarter, quarter after that, everything looks pretty unremarkable. I think it's just a matter of degree, but we are going to have most likely record corn stocks in both quarters. So there's really no urgency to ration available supplies. End users have their hands on a lot of it. There's really no need for the market to curtail future demand. South America, again, the growing season in Brazil, not quite over, but in Argentina, I think it is. And so we're kind of locked into having a lot of corn there in exportable positions and at elevators, and that can't be changed. So we'll get new numbers today, but last week the Argentine corn yield was 20% harvested. Yields are up 2%, actual yields up 2% year over year. And we're hearing a lot of things from our friends there that, rainfall, which has been pretty abundant the last 2 weeks, very late in the corn growing season, but it has been a net benefit. And so the idea is that maybe Argentina this year will produce 58 or 60 million tons of corn in calendar year 2026. Context, the USDA is at 52. Last year's crop officially was 50. And so you're adding something like 300 or 400 million bushels to Argentina's exportable corn potential in 2026. And some of this are, forward forecasts, but I think production growth kind of guaranteed that will exist in physical pipelines over the next 2 months. In Brazil, again, the harvest will start probably very early May and will span from then till the latter part of June, early July. So it's not quite over. But the biggest risk in Brazil, like we've talked about many times, is does it rain in April in northern Brazil or does it not? It can at times be a coin flip. And when it shuts off, let's say the rainy season exits northern Brazil in even the end of March, it does not rain again until October of that year. So you do see corn yield loss, the winter corn yield loss in Brazil of 15 to 25%. Well, this year it's raining. It rained this week. It's going to rain a lot in the next 2 weeks, maybe 4 or 5 inches in northern Brazil. You can see on the left, this is the percent of normal rainfall, and this highlighted area shows the principal winter corn belt. This is percent of normal rainfall from April 1st to April 22nd. It does assume the 2-week forecast is correct, but no early end to the wet season in Brazil. We kind of put the two together. Let's look at Mato Grosso. They produce about half of Brazil's winter corn crop by themselves. It seems to us that if you can get 12 inches of rain in Mato Grosso from March 1st to April 30th, you're almost guaranteed trend to meaningfully above trend winter corn yields. So through April 20th, again, assuming the forecast is correct, you're going to be at 12.6 inches. Maybe we get to 13 or 14. So I think the math is such that we're adding 1 or 2 million tons to total Brazilian corn production, not subtracting it. So the message here is that the South American growing season, for all intents and purposes, has come and gone, and there were not threats. We think that production in South America, probably barring some pretty abnormal frost events in Brazil, going to be the largest on record by 8 million tons, maybe 10, maybe 12 million tons. We'll keep a close eye on the evolution of Argentine yields. Again, everyone's talking very, very highly of them, but again, we're only 20% harvested. We'll take it week by week. But this is going to add 550 million bushels to total South American corn exports relative to last year. Most likely, a sizable portion of that will be subtracted from U.S. export potential. And that just makes sense. We'll grow trade as a whole. Consumption will grow. That pie will be getting bigger, but the South American markets, we think, will be very aggressive this summer. Argentina is already the world's cheapest corn origin by about 20 cents per bushel. That market seemed to be preparing for a very large crop and the need to export record amounts of it. So this is kind of the message. It's not really forecasting U.S. weather yet. It's not our opinions on the evolution of war. It's just that there's a record amount of bushels in the U.S. today, and there will be record production in South America. Physical markets will be well supplied. And otherwise, we're seeing soybeans similar. The soybean market will be more sensitive to we don't know if China's going to come back for old crop soybeans or not. We think that tonnage, if they do, will be low. But the South American growing season coming to an end. It will be the largest Brazilian crop on record, up about 10 million tons or 400 million bushels on last year. Argentina will be about unchanged on last year. And you can see in the cash market, so FOB premiums, this is the basis that the importer will pay for actual supplies. Still pretty deeply negative in Argentina, barely positive in Brazil, and both markets are about 60 to 80 cents per bushel below the United States. That is not uncommon this time of year, given South American harvest kind of in full swing, but also thinking about what it implies. So maybe China does buy additional soybeans from the US, but in normal years, and this is not even by itself bearish, but you can see the pace of US weekly export sales for soybeans. Just kind of drops off a cliff after January. The importer switches to South America and then kind of on its way to something like zero between now and the end of summer. That is the normal evolution of soybean export disappearance in the US. And so we're questioning, I don't know why it won't look like that in 2026. South American beans are cheap. China's hog prices are the lowest they have been in 6 years. I don't think there's a need for more meal production there, but we don't see the evidence outside of politics to really change soybean demand higher, not lower, because of South American production. And something that we've talked about before, which is seemingly not relevant to the US feed market or the upper Midwest feed market specifically, but it is North Africa and the Black Sea, and thinking about winter wheat. So again, we're entering this new growing season. Markets are fairly deflated because there's a lot of stuff. Do we produce the same amount, or can we replicate last year's growing season, which was pretty good worldwide, in 2026? And we don't know. The jury is out on that, but we're kind of starting off pretty well. It has rained in abundance in the deserts, essentially, of North Africa since December of 2025. This is one of the largest grain importing regions on earth, and they're still going to have to import grain, probably a sizable amount of wheat. But what you're looking at on the left is vegetation health as of the end of March compared to last year. And you can see the very, very bright royal blue. We are now out of categories to present just how healthy vegetation is in North Africa. So probably their wheat imports will be down 4 or 5 million ton from last year. So we're struggling to grow total wheat demand. Going to be a large crop, probably the largest since 2020. On the right, you're looking at Black Sea percent of normal rainfall from April 1st to April 21st. Highlighted is the winter wheat producing areas. And what we really want to focus on, if you can see this, is this kind of southern part of Russia. That is where a majority of Russia's wheat is produced. And most of it, that's where the exportable surplus comes from. It is the wettest it's been there in about 5 years. And so the season has just started. It is going to be conditions in May that matter most, but there's not going to be a shortage of water in kind of Central Asia, European breadbasket. So probably we're looking at the absence of threats there. Winter wheat production in Russia will again be very, very large. That bodes poorly for US exporting wheat, which allows feed operations to have access to very cheap wheat again in summer 2026. Indian wheat, the USDA today, maybe the only interesting change they made in their WASDE report is they did trim domestic wheat demand in India by 4 million tons and raised stocks there by 4 million tons. 2 years ago, we thought India was going to run out of wheat. They had on hand only about 20 days worth of consumption. In 2 years, that has ballooned stocks have ballooned from 7 million tons to 22 million tons, probably gets to 25 million tons in 2026. In 2 years, we think India is going to export modest tonnages into nearby neighbors only, but the market in India has dropped $3.20 per bushel in the last 15 months. So this is not telling us that the grain market globally is poorly supplied. It's telling us the opposite. When we get into the U.S. season as well, drought coverage is not small. And what we'll be watching, I think specifically, is going to be the Western Plains, Nebraska, and probably Arkansas. Can they solve drought by maybe the first half of May is always important from a climatological perspective, the southeast. So drought's not small, though we've almost eliminated it from the principal Midwest. And what you're seeing on the right is the 7-day forecast from the Weather Service. So on balance, drought coverage the next 7 days will be getting smaller, not larger. And so we're comfortable today being unconcerned about water availability in the primary growing regions of the U.S., at least as we get into the planting season. This rain's been very timely. but it is happening and going to happen again. 8 to 15 day periods also wet. We're also starting to see, these are going to come fast and loose at us, but everyone's, the climate forecasting community, their general ideas about summer weather, it is pretty unremarkable. Everyone's pretty normal temperatures, precip, climate signals, no early frost, most probably. And even when we think about drought in the Western Plains, I think it's important to kind of look through the details of hard red wheat supply and demand. So we planted the lowest ever acreage. We are looking at a yield, we think, of 41 bushels an acre. That is 6% below trend. So kind of accounts for dryness. But we're carrying over 450 million bushels, and assuming we do not gain market share because of weather in North Africa, the Black Sea, etc., you're still left with 400 million bushel end stocks. So this year, at least, drought's not meaningful to hard red winter wheat supplies in the United States, unless there is a weather problem elsewhere. In row crops, we're going to talk about just this sliver of ocean in the equatorial Pacific, where if it's cooler or warmer than normal, has this really outsized impact on a lot of climate patterns, El Nino or La Nina. This is the evolution of ENSO since January of 2000, and we're recovering from a very modest La Nina. It's that part of the Pacific is warming very quickly. And all of a sudden, you may have seen this in your local news, in fact. Super El Nino has been the talk. And before we get there, it does seem that the smartest people in the room, computer models, all project pretty rapid warming, El Nino by June, very strong, abnormally strong El Nino by August. And so I think that some degree of El Nino lies ahead of us, and it probably develops by the early part of summer. On balance, that has in the past been pretty mild Midwest summers and Midwest, kind of abundance of rain, the entire central US, even into southern Canada. It's not every year, but here is what corn and soybean yield performance relative to trend look like when we isolate El Nino summers since 1980. And so it is somewhat interesting. I mean, we cannot say today that we'll avoid something like 2002 in soybeans or 1991 in corn, but if we look at all years since 1950, El Nino summers provide about an 80% chance corn and soybean yields will be at or above trend. If we look at neutral ENSO, so neither El Nino nor La Nina, you have about a 70% chance of meeting or exceeding trend. If La Nina is present, you have only a 40% chance that summer weather will be fine and will meet or exceed trends in corn and soybean yields. So at least we're going into the growing season thinking we have the highest chance of meeting or exceeding trend in corn and soybean yield. So again, just thinking about probabilities, risk, is it being diminished? Is it being expanded? Given it's raining in the Midwest recently in the next 7 days, et cetera. And so thinking about too, if corn yield in 2026 is 2% above trend, that is a 188 bushel per acre yield. And we're not going to go there yet, but I just wanted to present that as a reasonable expectation if we do get into August and we have avoided heat and dryness. Corn market will be oversupplied. A 2% above trend soybean yield is 54 and a half bushels an acre, which very quickly puts the soybean market into something close to oversupply. So this is all weather. We'll revisit this 2 weeks from now, 2 weeks after that. But El Nino is important. So when you think about super El Nino, in all the media reports you're going to see, just think about it tends to be pretty good for Midwest weather. Maybe not as hot as we would like it, but very, very good for crop production. And after the USDA's stocks and seedings numbers, we've kind of put together today, assuming normal weather, El Nino, the most probable scenario for supply and demand. Today we're assuming 184 bushel an acre corn yield, carrying over about 2.2 billion bushels. Exports will contract a little bit because of that South American crop that we just talked about, and everything else kind of falls into place, doesn't change very much. So now we're at 2.4 billion bushels, which correlates pretty strongly to a cash price of about $4. And something we've highlighted before is this number, it's going to be about $4 cash price unless this red number, ending stocks at the bottom of the balance sheet, is below 1.5 billion or above 3 billion. It's going to be very hard to move along this price curve. So we're expecting a market similar to the last 12 months in corn. But I guess too, if you had a 188 bushel an acre yield, this number at the bottom of the 26-27 balance sheet jumped to 2.8 billion. Maybe that is a risk that we get into the middle part of summer. Soybeans as well. We didn't plant, or not intending to plant as much as we thought, about a million less, rounded up to 85 million planted acres. But assuming trend yield, assuming additional growth in crush capacity, and a modest recovery in exports, we're still left with more soybeans next year than this year. If yield is 54.5, this number jumps to about 480 million bushels. Will that be a risk in the soy market come middle of summer? In any case, we're just kind of struggling to find the USDA or the market or ag resources. Someone has to present a balance sheet that kind of includes fear of forward supplies. And that's just very difficult to do today. And I think it's left to Mother Nature to do that. And this is where we are thinking about harvest. And there's a lot of things to work through, but I wanted to show these today because for a couple of reasons. So this is something we do for every USDA report. Just the price of December corn on the day that the September WASDE is released, compared to that WASDE's U.S. corn stocks to use ratio. Not perfectly correlated, but you can see that more supplies, lower price, and vice versa. So we, the USDA, most of the trade, somewhere between, call it 12 and 16% stocks to use for 26-27 corn. Clustered. That is a $350 to $450 market and has been every year that's been the case. And I think what's important to think about here too is this goes back to 2007. And so since 2007, there have been varying levels of crude oil prices and presidential elections and geopolitics. But this is the model. And so you can see that unless the USDA can present new crop U.S. corn stocks to use below 9%, there is downside risk in the corn market. And that's not unusual. That is just tends to be what happens after spring if weather problems are avoided. Same thing with soybeans. Again, thinking about geopolitics, crude oil prices are all built into this. If the USDA cannot present new crop U.S. soybean stocks to use below 5%, there could be upwards of $1 of downside risk in November soybeans. And again, that's kind of unremarkable, but if you're producing things, watching this, just be very cognizant of that. I don't know when seasonal highs will be scored. Maybe it's this week, maybe it's 2 weeks from now, but the market will evolve as it normally does. And again, these are all rooted in perceptions of physical supply and demand. We have the most in August. We have the least in May, June. We are closer to May, June than we are to August. And so I think that if the markets were to turn around pretty quickly, that would not be unique to the grain space. That tends to be what happens all of the time. And in background too, we're thinking about record South American production, El Nino. We didn't really change total planted acres to all crops in the U.S. this year. So there's going to be a lot of stuff that there's not a weather threat. So kind of more of the same from us. Feed markets well supplied, neutral trends, milk prices neutral, volatile and at elevated prices. But again, kind of managing risk margins is still pretty key if we think about the period from now till the end of Q1 2027.
Well, Ben, thank you for jumping in at the start of this when my internet decided not to work right as we got things kicked off. But B, also for your time here today. We do have a couple questions that we'll take quickly here to be considerate of time. The first one reads, is the cheddar market the biggest contributor to the potential milk price change later this year? Is this the biggest indicator we should be watching, or is there something else likely to make waves?
I think it's going to be the biggest contributor. Yes. I think that the things that we'll be watching when we think about, your forward cash milk checks, the correlation to class 3 is pretty strong. And so even the forward market's kind of telling you more or less what those will be. But if the cheddar market can't break below, $1.60 per pound, and again, whey, non-fat dry, and butter, I think, will tell you if this $2 or $3 premium holds. So I would think if we're thinking about the premium between class 3, over class 3, in your cash milk checks, I would look at the whey and non-fat dry prices to know if that's going to be $1.50 or if it's $3. If whey and non-fat dry stay elevated, we're going to be at the upper end of that range. So I think that's what I would look at when we're thinking about forward milk prices.
Okay, good things to be thinking about. And then last question is, we have the cows, markets are balanced, farms seem to be expanding. Are we setting ourselves up for oversupply?
A very good question. And I think that probably not. Maybe you find kind of lower plateaus over the next 24 months if we have the cows and we're producing as much as we are today in foreign markets as well, Argentina, New Zealand. But I think what's pretty clear, and food consumption trends do change, nothing really lasts forever. But I think for the next couple of years, protein is going to be at the top of everyone's list for a lot of reasons. I mean, dairy products are incredibly healthy and nutritious. I think GLP-1 use will exacerbate the need for protein. I think protein is going to be at the very top of food pyramids globally, whether officially or not. But I think that works in the favor of the US dairy farmer. Starch, probably not. So corn is kind of subject to weather patterns and what happens in South America. But the US dairy farmer will benefit from protein demand. I don't think we're dealing with oversupply in the next 2 years. We'll revisit food consumption trends after that.
A lot of things to be thinking about on the dairy front here. But that's the last question we have for you here, Ben, this afternoon. I just want to say thank you for your time as always. It's much appreciated to have you on here on the Dairy Signal.
My pleasure.
Quick thank you once again to DLF for their support of the Dairy Signal this April. And if you're wondering what's coming up for PDP and programs, we have our AI Smart Dairy Workshop next week. Only a few spots left for both those days in Chippewa Falls and Manitowoc, Wisconsin. So get registered if that's on your plate. But for now, otherwise, have a great weekend and we'll see you here Tuesday on the Dairy Signal. Bye now.